Hi, this is Todd with the market update. Today we're going to talk about managing risk with eyes wide open. Certainly anybody who watches the news knows we're living in abnormal times from an investing standpoint. When you think about negative rates around the world, rates could be rising, potentially high debt, trade wars, lots of different problems. There's also a chance, and on top of all that, we have a crazy presidential election coming up, possible impeachment, Brexit on a global basis, and so forth. There's also some things that could go right. We could get some trade resolutions with Mexico, Canada, Japan, EU, possibly a trade resolution with China. We could have a huge investment in infrastructure. Certainly, there's some things that could go right around the world. So today in the conversation in these slides, you can pause these slides as needed to look at the details because I'm going to go rather fast. But stocks may be expensive relative to history, but they might be cheap compared to where bond yields are today. So the key is to be prepared and to know how to manage your risk, what your risk tolerance is, and what you can do about it proactively. So how do we prepare for eventual bear markets? Because they're going to happen eventually. So number one is understand your willingness and need and ability to take stock risk before the bear market. Can you sleep at night with a 30 to 55% decline in stocks? This is perfectly normal in a bear market. And then how much risk do you need to take to hit your goals? Number two, don't hold more stocks in a bull market than you're comfortable holding in a bear market. Bear markets are a surprise and they happen without warning. Number three, pay down your debt and don't have too much leverage. Have the ability and plan for a 3 to 4 year bear market and recovery. Number four, hold enough cash and short-term bonds to cover cash flow, hopefully rebalance and buy more stocks when they're on sale. If you're retired, consider having at least 18 months of cash needs or cash flow needs in a high interest money market account like Capital One or high quality bonds. And number five, mentally prepare for a bear market or at least lower returns in history for both stocks and bonds over the next, say, 5 to 10 years. And we have to ask, are we prepared? Are you prepared? So here's a nice chart that gives us sort of a cheat sheet on the range of amount of equity exposure to have and what the decline in the portfolio may be. So if you have a standard 60-40 portfolio, in a bear market, you might lose 25% of your portfolio. So $1 million portfolio would lose $250,000. If that's not something you can sleep at night with, knowing that possible outcome, it's probably wise to reduce your level of stocks. So in a typical 60-40 portfolio, 90% of the risk comes from stocks, and you have to keep that in mind. So since 1926, we've had a lot of bull and bear markets. And you can see this most recent run is up over 400%. I've got another slide on this and how long they typically last. We're currently over 10 years in a run of over 400%. Bear markets are swift and quick, and the last couple have had max drawdowns of over 50%. So keep this in mind from a long-term perspective. U.S. bonds typically do okay during bear markets. So U.S. bonds over the last several bear markets have been up about 9%. Probably today more realistic of say up 5 or 6%. Where U.S. stocks, the last couple of recessions again have been down 50% or so. And technology stocks seem to get hit the hardest in a bear market. So here's where we are today. The S&P 500 with dividends from the lows over 10 years ago are up over 450%. Today, as I record this on October 25th, we're hitting all-time highs again for the S&P 500. So it's been quite a run. And if you look at it over the year-to-date and over the last several years, growth has outperformed value. And growth may be a little bit more expensive than value companies over time, and we'll touch on this here in a couple other slides. So over the last year or so, U.S. stocks have done the best. Actually, over the last 10 years, U.S. stocks have done the best. International stocks and emerging market stocks have been down over the last year. And even when you look out over the last, say, 5 or 10 years, it really has been the U.S. stock market that has driven much of the performance. International stocks are at lower valuations and may provide better returns moving forward. That is yet to be decided. But you can see even over the 10-year period, U.S. stocks are up 13% per year, where international and emerging markets are only up 3 to 4.7%. One of the reasons that may change in the future is if you look at global consumption by country, developed markets versus international markets, the projections for 2030 is that over half of the global consumption will come from emerging markets. So a big change in the growth of middle-class consumers in emerging markets. And when you look at that, that's where most of the growth in the world is going to come from. When you look at 2030, only 23% is projected to come from the Americas, so North and South America. So a big difference there over the next 10 or so years. When we think about bonds, bonds are a pretty easy part of the equation. The starting yield for bonds, which today is 1.6, 1.7% for the 10-year, really has a very high correlation to what you're going to make over the next 5 and 10 years for bonds. So bonds are at some of the lower parts of history. They may go to zero. They have in much of the world. But we may also just have low returns over the next 5 or 10 years from bonds. One of the other interesting things is when you look at total shareholder yield, so this is companies buying back their own stock and the dividend yields, you can see that for many industries within the S&P 500, the total yields are 4 to 5%. So high quality stocks have strong relative yields versus bonds. Again, the 10-year bond is only returning, say, 1.7%, when many stocks are returning 4 to 5%. Here's another way to look at this is buybacks are in the red and dividends are in the green, but buybacks have been exploding over the last 10 years. This, again, looks quite favorable compared to bonds. Many people project that the risk-free rate for the 10-year bond should be more around 3 or 4% instead of 1.7% today. So here's a recap of some different time frames for stocks. Again, you can pause any of these slides to take a look in more depth. But over the last 12 months at the end of Q3, interesting, bonds actually were up about 10% over the last 12 months, which is much better than the 3.2% for the S&P 500. You can also see low volatility stocks did well, technology did well, dividend growth companies did well compared to the S&P 500. Since 2018, this is an interesting chart. Again, very busy, but you can pause any of these. But tech, growth, and momentum and dividends have all done better than the S&P 500, up about 11%. And again, dividend growth, momentum, low volatility, and tech have all done better than that over the last, since 2018. Over the last 3 years, you can see, again, here's the S&P 500 up 45%. Again, low volatility, dividend growth, momentum, and technology have all done better than the S&P 500, with value in international and emerging markets doing worse. And over the last 5 years, you can see here's the S&P 500 plus 64% with dividend growth, momentum and low volatility, and technology doing better. Again, value and bonds and emerging markets and international doing worse. So many people have probably heard, but growth has been trouncing value over the last 10 years or so. This chart shows what happens after long periods of that happening. It's happened before, right? It happened back in the 90s. And then over the next decade, value went on to outperform. And you can see this has happened many times over the past. We don't know if this will happen now, again. But certainly there are some companies that are considered value companies that are much cheaper and better valuations than some of the high-tech growth companies. It has yet to be seen what will happen over the next 10 years or so. When you think about long-term investing, which is really what we want to think about, even if you're retired, you probably still have 20 or 30 years worth of investing. We want to get compounding over decades. So this is a chart over the last 43 years from 1976 through 2019. And these are, I'm going to translate these into real return. So a real return for bonds, $1 million invested back in 1976, would have grown to $4.7 million real return, or a return of 3.6% per year in bonds. For the S&P 500, which is this green line, the real return would have been $24.6 million, or 7.6% per year, real return after inflation. And then for a mix of S&P 500 with value and small cap, the return would have been $48 million, or 9.3% real return per year. So over decades, we want to be invested in stocks for the real growth above inflation over long periods of time, especially from today's low starting valuations for bonds. It's very clear that bonds over the next, say, 5 or 10 years will not return a real return of 3.6%. So this is going to be really unachievable, and probably stocks will return lower than these historical averages, but still potentially better than bonds. Here's another way to look at this. This is a 43-year chart. This is rolling 10-year periods, and you can see these are nominal returns. But you can see the green line is the bonds, and you can pause again these slides. But the S&P 500 is this blue line, and these are 10-year rolling periods. So you can see value and small cap and so forth tend to move around during rolling periods. Right now, they're all very close over the last 10 years. And typically much better return in stocks than bonds in rolling 10-year periods. Although back here you can see obviously some did worse in the great financial crisis. So over the last 10 years, bonds have returned about 3.2% per year, stocks 13 to 14% per year. Over the last 43 years, bonds 7.6% return, very high. We're not going to get that moving forward. Stocks about 12, 13%. But if you look at low quartile for returns, bonds have been at about 5.4%. We're probably going to see lower than that over the next 5 or 10 years. And stocks at 7.6%, and we may see that or lower for stocks over the next 5, 10 years. When you start to look at 20-year returns, you can see that stocks consistently do better than bonds for long-term wealth accumulation. You can also see, it's interesting here, is the S&P 500 is this lower line. Over longer periods of time, value, small cap, and so forth tend to do better than the S&P 500. So again, you can pause these and go through, but over the last 20 years, bonds have returned 4.6%. We're probably going to see lower than that, and stocks have averaged 6.1 to 8% per year. So what do we do as we bring this all together? I think it's important for clients to be managing risk at this point in time in the cycle, being prepared and planning for recessions. So again, here are the 5 things. Understand how much risk you need to take and you're willing to take to hit your goals, so you can sleep at night. Don't hold more stocks than you're comfortable with, especially in a bear market. Paying down debt and leverage and planning to withstand a 3 to 4 year bear market and recovery. Holding enough money in cash and bonds to cover your cash flow, especially if you're retired, and mentally preparing for bear market, or at least a minimum of lower returns in history. So keep these in mind. If you need help, let's schedule a call and talk about it, and make sure we are planning to manage risk with our eyes wide open, no matter what the outcome is. Stocks can keep running for several more years, or we could have a recession and bear market. We need to be okay with either outcome and be okay as to how we manage risk moving forward. Thank you. If you have additional questions or concerns, please schedule a call, and have a great week. Thank you.